$70 silver? Citibank's shocking prediction. Every investor needs to hear. A number just left Wall Street speechless. $70. Not a rumor, not a YouTube prediction. A formal target from one of the largest banks on the planet. And while most investors are still asking, will silver go up? Citibank has already moved on to a different question entirely. How high and how fast? Because behind this number lies a chain of events already in motion. A deficit spiraling out of control, a metal disappearing from vaults, and a window of opportunity that history shows never stays open for long. By the end of this video, you will understand exactly what Citibank sees, and why the next few months may decide who profits from this moment and who simply watches it happen. Stay until the end, because Part 5 reveals the one detail almost nobody is talking about. Welcome back to Precious Metals Intelligence, the channel dedicated to cutting through the noise and delivering the strategic, historical, and economic context that serious investors actually need. If you're new here, this channel exists for one purpose: to help thoughtful, disciplined people understand where real value is moving in the world, calmly, clearly, and without the hype. Before we begin, a quick and genuine question: where are you watching from today? Drop your city or country in the comments below. This community spans the entire globe, and it's always worth seeing just how far these conversations travel. On a quiet Wednesday morning, while most people were checking headlines about jobs and inflation, something different landed on the desks of major investors. It was not a rumor. It was not a headline written to grab clicks. It was a formal note from Citibank, one of the largest financial institutions in the world, and it contained a number that made analysts stop scrolling and start reading carefully. $70. That was the price Citibank's analysts said silver could reach within the next 6 to 12 months. At the time, silver was trading closer to $65 an ounce. For many people outside the financial world, a $5 or $10 move might not sound dramatic. But for those who understand how institutions like Citibank operate, this was not a small statement. It was a signal. Big banks do not release price targets casually. When an institution the size of Citibank puts its name on a specific number, it is not guessing. It is putting its reputation, its research team, and its client relationships behind that call. Analysts do not want to be wrong in public. So when they choose to publish a bullish target instead of staying quiet, it usually means they have looked at the data closely and feel confident enough to speak. This is very different from the kind of predictions people see from independent commentators online. Anyone can say a price will double. It costs them nothing if they are wrong. But a bank like Citibank has clients, shareholders, and a public track record to protect. That is why serious investors pay close attention when banks like this speak clearly about metals like silver. But to understand why this number matters, it helps to step back and think about what is actually happening here. Most people assume that when silver's price goes up, silver itself is becoming more valuable. That is only half the story. In reality, a large part of what people are seeing is not silver becoming more valuable. It is the dollar becoming less valuable. This is a simple idea, but it is one that most people never stop to consider. A dollar today does not buy what it used to buy 10 years ago, or 20 years ago, or 50 years ago. Prices for food, housing, and everyday goods have been rising for decades, not because those things suddenly became better or more useful, but because the money used to buy them has been losing strength. Silver and gold, on the other hand, do not change. An ounce of silver today is still an ounce of silver. It has not changed its nature. What has changed is the number of dollars needed to buy it. Once this idea becomes clear, the entire silver conversation looks different. It is not just about a metal rising. It is about a currency slowly losing ground. And when a currency loses ground quickly, at the same time that people no longer expect it to, the shift can happen faster than anyone plans for. This is exactly where the current moment becomes interesting. While ordinary investors are still asking simple questions like, should I buy silver? Institutions like Citibank appear to be asking something more advanced. They are asking how fast the value of money itself may be changing, and how that change could affect the price of hard assets like silver over the next year. This creates a strange and important gap. On one side, there's the general public, many of whom still see silver as a small, old-fashioned investment, something their grandparents may have collected as coins. On the other side, there are large financial institutions quietly repositioning their outlooks, publishing formal targets, and preparing clients for a very different price environment than the one most people expect. History has shown again and again that this kind of gap between public understanding and institutional positioning does not usually stay open forever. Eventually, one side catches up to the other. Either the public becomes more cautious and the institutions turn out to be wrong, or the public slowly realizes what is already happening and begins to react, often much later than the institutions themselves. Right now, all signs point toward the second outcome. And if that is true, the real question is no longer whether silver moves. It is what is actually driving this shift behind the scenes, deep inside the financial system, far from the headlines most people read every day. That is where the story goes next. Behind every price target from a major bank, there's usually a bigger story. Citibank's number did not appear out of nowhere. It came from a careful look at the condition of the United States economy and what analysts found is not comforting. The story starts with a word many people hear often but rarely stop to think about: deficit. In simple terms, a deficit happens when a government spends more money than it brings in through taxes and other income. The United States has been running large deficits for years, but recently the size of these deficits has been growing faster than expected. Just recently, government figures showed that the country's budget deficit for a single month reached over $400 billion. To put that in perspective, that is almost half of $1 trillion, spent in excess in just 30 days. And this was nearly 50% higher than the same month 1 year earlier. This is not a one-time event. It is part of a pattern that has been building for years. Now here is where things become more serious. When a government spends more than it earns, it borrows the difference. That borrowed money becomes part of the national debt. And the national debt does not sit quietly in the background. It comes with a cost, known as interest expense. The larger the debt becomes, the larger the interest payments become. Today, the United States government is paying more than $1 trillion every single year, just in interest, on debt that was borrowed in the past. This creates a cycle that experts often call a debt spiral. It works like this. A large debt creates a large interest payment. Well, that large interest payment adds to the deficit. A larger deficit means more borrowing is needed. More borrowing increases the debt even further. Then the entire cycle repeats, each time slightly larger than before. This is not a one-time problem that can be solved quickly. It becomes a repeating pattern that grows heavier with each cycle. At the same time, another major financial pressure is building in the background. Over the next 12 months, the United States government will need to refinance an enormous amount of existing debt, with some estimates placing the figure near $9 to $10 trillion. This means the government must find buyers willing to lend that much money all over again. But the government is not the only one competing for lenders right now. Large technology companies, especially those investing heavily in artificial intelligence infrastructure, have also been borrowing enormous sums of money to fund their expansion. These companies are issuing large amounts of corporate debt at the very same time the government needs to refinance its own obligations. This creates a difficult situation. There is now a massive combined need for borrowed money coming from both the government and major corporations, all competing for a limited pool of available lenders. When demand for borrowing becomes this large, it puts upward pressure on interest rates because lenders can demand higher returns for their money. This is where the Federal Reserve, the institution responsible for managing the country's money supply, faces a difficult choice. If interest rates rise too high, it becomes very expensive for the government and businesses to keep borrowing. But if the Federal Reserve wants to keep borrowing costs manageable, it may need to create more money to help absorb all of this new debt. In simple terms, this process is often referred to as money printing. When more money is created and added into the financial system, each existing dollar becomes slightly less scarce. Over time, this can lead to a gradual loss of purchasing power, which is another way of describing inflation. History has shown across many decades and many countries that periods of heavy government borrowing combined with monetary expansion often lead to rising prices for hard assets like gold and silver, because these metals cannot be created out of nothing the way paper currency can. This is the deeper environment behind Citibank's bullish outlook. It is not simply a bet on a metal. It is a response to a financial system under growing pressure, where debt, interest payments, and new borrowing needs are all rising together, creating conditions that have historically pushed investors toward assets that cannot be printed. But debt and deficits are only part of the picture. Underneath the surface of the market itself, something else has been quietly building, something tied directly to the physical supply of silver and how that supply is beginning to change. While government debt and monetary policy explain the wider economic backdrop, they do not fully explain why silver, specifically, has captured so much attention from major institutions. To understand that, it helps to look past the headlines and into the actual mechanics of the silver market itself, where a quieter and more technical story has been unfolding. Silver is unusual compared to most investment assets because it serves two very different purposes at the same time. On one hand, it is treated as a monetary metal, something investors buy to protect their wealth, much like gold. On the other hand, it is also an industrial metal used in electronics, solar panels, medical equipment, and a wide range of manufacturing processes. This dual identity makes silver behave differently from almost anything else in the financial world. For much of the past year, large amounts of silver were pulled out of major exchange-traded funds, the investment vehicles that allow everyday investors to gain exposure to silver without holding physical bars or coins. Tens of millions of ounces left these funds over several months. Normally, this kind of outflow would be expected to push prices lower. Yet despite this steady drawdown, silver's price held firm and did not collapse the way older market patterns might have predicted. This detail matters more than it might first appear. When an asset experiences heavy selling pressure but still manages to hold its value, it often suggests that new buyers are quietly absorbing that supply from the other side. In this case, much of that silver appears to have been used to fill a growing gap between how much silver is being mined and how much is actually being consumed each year, a gap commonly referred to as a supply deficit. Now, analysts are pointing to early signs that money may be starting to flow back into these same silver funds, reversing the previous trend. If this shift continues, it would mean that investment demand, which had been quiet for months, may be waking back up at the same time that industrial demand remains strong. Both forces pulling in the same direction at the same time is historically rare, and it tends to create sharper price movements than when only one type of demand is active. There is another important measurement that analysts use to judge silver's potential, known as the gold to silver ratio. This simple calculation shows how many ounces of silver it takes to equal the value of 1 ounce of gold. For most of history, this ratio has stayed within a fairly stable range. Recently, however, it has remained unusually high, meaning silver has been historically cheap when compared to gold. When this ratio eventually narrows, silver tends to rise in price faster than gold does, simply to close that gap. Some analysts believe this ratio remains far above its long-term historical average, suggesting there is significant room for silver to catch up. At the same time, industrial demand continues to grow steadily in the background. Electric vehicles, renewable energy systems, and advanced electronics all rely on silver in ways that cannot easily be replaced with cheaper materials. This creates a structural floor of demand that exists regardless of what investors decide to do, adding another layer of support beneath the price. When these factors are placed side by side, a pattern begins to form. Investment demand may be returning. Industrial demand remains strong and steady. Supply has already been tightening for months, and the historical relationship between silver and gold suggests there is room for a larger move. Individually, none of these factors would necessarily be dramatic. But when several forces point in the same direction at the same time, analysts often describe the resulting setup as asymmetric, meaning the potential upside appears significantly larger than the realistic downside risk. This is not a guarantee. Markets can remain unpredictable and prices can move against expectations for extended periods of time. But when institutions like Citibank build formal price targets, they are often responding to exactly this kind of alignment, several independent signals converging at once rather than reacting to any single piece of news. Still, none of this fully explains why moves like this, once they begin, often happen far faster than expected. To understand that part of the story, it helps to look further back in time, to previous periods when similar conditions appeared in the market, and to see what history has already shown about what tends to happen next. Markets rarely move in straight lines, and silver has proven this many times throughout history. To understand what may lie ahead, it helps to look back at earlier periods when similar conditions appeared together, and to study how those situations eventually unfolded. Throughout modern history, there have been several distinct periods when heavy government borrowing, expanding money supply, and tight physical supply of precious metals all occurred at the same time. In nearly every one of these periods, the eventual price reaction did not happen gradually. It happened suddenly, often catching casual observers by surprise, even though the underlying pressures had been building quietly for years beforehand. One important factor behind these sudden moves lies in the supply side of the market, something that receives far less attention than price charts or news headlines. Mining new silver and gold is not a fast process. When a new deposit is discovered, it can take 5 years or more before that discovery becomes an actual functioning mine. Once production begins, most mines operate for somewhere between 10 and 20 years before their supply naturally declines. This means that the supply of silver available many years from now was largely determined by decisions and discoveries made long ago. And here lies a significant concern. Over the past 2 decades, the number of major new silver and gold discoveries around the world has declined sharply. Some recent years have produced almost no major new discoveries at all. Because of the long lag between discovery and production, this shortage of new discoveries today points toward a much tighter supply picture in the years ahead, regardless of how strong demand becomes. This combination, rising demand paired with a supply pipeline that cannot expand quickly, is exactly the kind of setup that has preceded sharp price movements in the past. Unlike goods that can be manufactured quickly when demand increases, silver cannot simply be produced faster just because more people want to buy it. This is what economists refer to as inelastic supply, and it plays a major role in why precious metals markets can move so abruptly once a shift in demand truly begins. There is also a psychological pattern that tends to repeat throughout economic history. In nearly every generation, the general public underestimates structural shifts that are already visible in the underlying data, right up until those shifts become impossible to ignore. This is not a criticism of ordinary investors. It is simply a reflection of how most people experience the economy through daily prices, wages, and headlines, rather than through long-term structural indicators like mine supply, deficits, or currency expansion. By the time these shifts become obvious to the general public, institutions have often already positioned themselves well in advance. This is not because institutions possess secret information. It is because they study structural conditions like the ones already discussed here, long before those conditions become mainstream news. This is precisely why Citibank's recent price target deserves closer attention. It is not simply a short-term prediction. It appears to be a response to a series of long-term structural forces, government debt, constrained supply, and shifting investment demand, all converging at a similar point in time. History suggests that when this kind of alignment has occurred before, the resulting price movements have often been faster and larger than most people expected in advance. None of this guarantees a specific outcome, and no analysis can predict markets with certainty, but the historical pattern is clear enough to take seriously. Structural conditions build quietly for years, largely unnoticed by the public, until eventually the imbalance between supply and demand becomes too significant to ignore any longer. There remains, however, one additional detail that ties everything discussed so far together, something quieter than price targets or deficit figures, yet arguably more important to understand than any number by itself.